Well, a Fed pause seems fully baked in at this point, but are we getting ahead of ourselves ahead of tomorrow's CPI data? Joining us now, we've got Kevin Gordon, who's Charles Schwab Senior Investment Strategist. Great to have you here with us in studio this morning, Kevin.
Morning.
Absolutely. All right, so as we think about some of the data that's set to come forth this weekend, what do you believe the Fed would need to see within CPI in order to give them hard conviction for a decision one way or the other?
I think it'd have to be a pretty major upside surprise. Upside not in a good way, in a bad way, especially on the core side. But, they probably left us with enough in terms of Fed speak and then, the labor report for May itself. That was probably enough to set us up for, if you want to call it a skip. I guess that's the new word now for June. But I think more important would be language around what it means for July, if it was a hotter number yesterday. And then even along with that, I think some of the wage data, that to me is going to be more interesting moving forward because you have, more research from some of the regional banks like the San Francisco Fed kind of talking about how, the wage dynamics may not be as much of a driver of inflation that the Fed originally thought. So kind of putting, less emphasis on the Phillips curve itself, I think it'll be important to see if Powell kind of reinforces that message and what it means for the broader Fed itself, the broader FOMC. That to me is going to be more important in conjunction with the update to the summary of economic projections. That's going to be, I think, pretty telling, especially if they adjust the unemployment rate statistic and what they expect for the end of the year. I think that'll be a pretty big tell because if it moves up a little bit, to me, that would imply they have to be a lot more aggressive in the second half of the year.
In other words, the dot plot, the summary of economic projections, what we call in layman's terms the dot plot. And I'm also curious what you guys are looking at to try to, we always try to figure out what are some more creative or even accurate inflation indicators, right? Besides just CPI, besides just the stuff that we tend to look at. Is there anything that you guys are watching?
There's higher frequency metrics. You can look at, dining statistics if you want to try to get a gauge of what activity and services is like. But, the reality is, and our view has been for a while, that we can look at all the data that we want and we can kind of get a gauge of, truflation, if you want to call it that. But the Fed has been pretty specific on what they're watching. So it's not even anything particular within CPI, it's within PCE. And then as we all know now, the core services ex-housing component. I think the distinction is really important because even within core services ex-housing in PCE versus the same metric in CPI, they're calculated differently and there's a higher and stickier weight in the PCE version. So we could look at the core CPI version and if it's coming down and rolling over, that would kind of give us the indication, okay, it's okay to pause, but they're going to be focused on the PCE.
That's so we can just ignore CPI then.
I wouldn't say ignore, but yeah, exactly. But I think it's important when you think about how they look at this. The fact that, whether you like it or not, they are kind of tied more to lagging economic data, but that's really the position that they put themselves in right now.
The fun thing over the weekend sometimes is having conversations with friends and really discussing everywhere the consumer is and isn't. And we've seen weakness in some of those more discretionary categories continue to hold up. However, if you start to think about all of the other places where consumers are monitoring where the Fed's actions are going to impact purchasing decisions on a large scale, that's what's become, I think, more asked about at the brunch table, if you will, these days.
And it's tough, too, because, everybody's inflation is personal, and it sort of breaks down to geography at some point, because even here in New York City, I mean, if you tried to tell somebody, oh, inflation X housing looks great, I don't think you'd be, that wouldn't kind of yield a good response. Very different in another area of the country where housing isn't as, big of an expense. So I think you have to keep that in mind, but you also have to keep in mind this kind of stress in the banking system that has seemingly abated, at least, over the past couple of months. What I thought was pretty interesting in the most recent Fed minutes is that they started to cite almost the reverse of what you would expect from the banking stress, that it actually wouldn't lead to as much contraction in the economy, but that it would actually almost have the reverse of a supply side effect. That was just a little tidbit. It wasn't anything that they expanded on a lot, but I think that's going to be the other component that's crucial in the press conference in particular to see how much they expect that to feed through. Because if you don't get as much of a credit contraction from what happened in the banking system stress, if that's not as much of a damper on inflation, then you kind of have a little bit of a higher support and kind of a higher seal or a higher floor for inflation itself. That makes it harder for the Fed to ultimately get to the 2% goal.
One of the interesting things that's happened in the market this year is there was a big pricing in of a cut by year's end. That seems to have abated to some degree. And I wonder what it says about Fed credibility. Because at the time you think, well, one of them's going to have to be wrong, right? Yeah. And the market has now decided, well, we were wrong, maybe, right? So does that then imply that the Fed has sort of gotten the market backed in a sense.
In a way, I think if you look at valuations, certainly as you move up the cap spectrum, and that mega cap story has been widely advertised at this point, with that sort of being the only source of leadership, albeit it's started to change a little bit in the past week, which I think is
Don't worry, we're going to talk about that.
Yes. But I think, now you kind of have the problem of, so number one, I would say, yes, it's good that the market has kind of priced out the majority of those cuts. There's still about one priced in for the end of the year, but the majority of those cuts being priced out as the market has rallied. But at the same time, that rally has been, there's been a strong bifurcation. So I actually think that, the weakness, or maybe just kind of the muddle through economic scenario that the market is looking at, is reflective of, when you look at the average stock. So, whether it's small caps or cyclicals, that, the lack of movement that you've seen this year, I think that's reflective of the broader economy, and kind of the flight to quality and the flight to safety up the cap spectrum. I think that was, definitely accelerated when you had the banking stress with SVB and Signature and then First Republic. So I think that there's not much of a muddy kind of picture there as it might be portrayed.
Yeah. Okay. Well, as I said, we're going to talk about some of these other issues. So hang on. Kevin's going to stay with us.